So in terms of sector by sector, what really is gaining here today, we talked about property. That certainly is a key beneficiary of these bigger cuts from the Fed here as well. And HKMA, yeah, following through this morning too, Steve.
Yeah, without surprise, obviously, given what the Fed did. The Hong Kong Monetary Authority has cut its base interest rate for the first time since 2020, moving as it usually does in lockstep with the Fed because of the peg to the U.S. dollar. That could help support the city's struggling property market. Bloomberg Intelligence senior APAC real estate analyst Patrick Wong is here. So we're seeing initial impact from this. It's not the panacea to the woes of the property market here in Hong Kong, but it'll go a little bit to alleviate those concerns at the developers, right?
That's true. I think now we want some positive catalyst to support the struggling market here. And definitely it's a great opportunity for developers side to sell more units. Especially, I think the housing market here, we see the price already coming down to 8-year low level, right, which is really challenging. And for developers side, I think lots of them, like Sun Hung Kai or New World, they have lots of units available for sales over the next couple of months. So definitely is something hopefully will be a positive catalyst. And the challenge, of course, for short term, right, the mortgage rate may still stick here because Hong Kong didn't follow US too much in terms of the interest rate high before. So it take a little bit of time to come down, maybe hopefully next year.
When you look at home prices now, I think we're at an 8-year low in Hong Kong. Rents, though, are going up. So you're seeing quite a bit of a divergence here. Are we likely to see that divergence continue, or do you think home prices could actually recover?
I think it takes a little bit time to turn around the thing, but you see the rent is going up, right? So last year, even this year, is something like 5%, 6% increase for every year. That is also a good sign that we see the demand is there. Just people...
No one wants to buy.
Yeah, they just wait a little bit because the interest rate is so high, right? So they wait until the interest rate will come down, and then potentially it makes sense. And also for some investment demand, right? The treasury yield you see is now 3.7%, and then your rental yield is going up a bit, right? From like 2.5 to now is for mass units is 3.6%, right? So potentially we see the rental yield is going higher than the treasury yield. That could also boost the investment demand.
In the commercial space, I mean, the anecdotal evidence that I've been hearing in places like Sai Kung and elsewhere is that a lot of these landlords, if you will, are underwater. They're negative equity because of the drop in the prices. They haven't been lowering the rents, and that's been causing an undue stress on the commercial market. Wouldn't you agree?
Yes, I think the retail market also struggling quite a bit, right? So that is also the reason why we see the price also coming down, and then the interest rate at high level also trigger. We didn't see much investment demand, especially for the commercial market, even office as well. So the challenge, I think, short term is still there, but hopefully the interest cost cutting, so we will benefit for the corporate as well.
Yeah, that's what I meant, retail, not necessarily commercial. Commercial, a lot of these skyscrapers are empty,
or
at least 40% are about relatively empty.
Yeah,
exactly.
Patrick, thank you, Patrick Wong there from Bloomberg Intelligence.